Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster of Victory Fiduciary, and welcome to the first Midweek Market Update for the month of March. And certainly February was an interesting month for the market. We saw some really pretty crazy market movements and swings, particularly towards the end of the month, which we're going to get into. And it's interesting because February is typically considered a weaker month for the market. We typically will see oftentimes negative returns for the month. It's just in market cycles, that's kind of how it goes. I remember thinking in the middle of February, man, this is great. Maybe we're going to kind of shake that old reputation for this month and start 2021 with like this new market history. And so unfortunately that kind of February kind of came back with a vengeance by the end of the month. And so, you know, for the last 2 weeks, we've been talking about seeing some corrective processes in the market. We've been seeing some pullbacks and stagnation, and nothing that was really out of the ordinary or unexpected because we had talked about the significant advances that markets have been making. Stocks cannot just go straight up as much as we want them to. They have to be able to come back, pull back, cool down, and then kind of like gather themselves and then be able to go ahead and reach new highs again. That's how markets work. So as we saw, markets were particularly deviated across the indexes, trading above their moving averages, really making some significant advances. Wasn't unexpected to think that we were going to see some short-term pullbacks, and so we began to see that towards the end of February. But last week particularly, we saw some very significant movements. We saw all of the major indexes were pretty deeply in the red, and we'll talk kind of specifically about those numbers. And this all kind of came back to 10-year treasury numbers that unexpectedly spiked at the end of the month of February. We saw the S&P 500 gave up nearly all of its gains that it had made for February in those last trading days. S&P wound up trading just slightly positive for the month. Other indexes were quite negative for the month. And so 10-year treasury numbers really since last year have been sitting at about 0.4%. And so this has a couple of implications. Number one, it means that if investors are looking to get any type of yield, they have to be in stocks or equities. They can't really get yields anywhere else. And the second thing is that when 10-year treasury numbers are so low, the cost of borrowing money is also very low. So that means that companies are able to borrow or leverage, and it will cost them less. And so this has pretty big implications for a company that maybe was already had some pretty marginal profit lines, and so to be able to have access to capital and not have to pay a lot for it was a really big deal. We look at the 10-year treasury. This affects mortgage rates, so people have been just coming in and buying homes. Mortgage rates have skyrocketed over the past 10 months or so because mortgage rates have been so low, and the cost of borrowing, so people have been able to go out, they've been buying homes. This also directly affects interest rates for auto loans, credit cards, so the average person being able to have access to borrow money, it's been very inexpensive up until now. And so rates have been sitting at about 0.4%, so there's ramifications all across the economy with this. But what we saw last week was they spiked to 1.6%, pretty unexpectedly, really took the market off guard. It really it rattled investors, it spooked them, because now thinking, you know, number one, these companies that have such thin profit margins to begin with, particularly in the small and the mid-cap space, what's this going to mean for them? We're now going to make things be more expensive than what they were. What's this going to mean, especially in areas of the market that were particularly overvalued? So, you know, we've been talking for weeks about the fact we're trading above our 3 standard deviations above our means, and that what does that mean? And we're going to have an exogenous event potentially that could come in, kind of catch the market off guard, and we will probably see some type of reversion back closer to the mean because we are just trading so far ahead of ourselves essentially. And so we saw some of that begin to happen last week. And the NASDAQ, which is predominantly tech, was down 5% in 5 trading days, pretty significant. And that was really led by companies like Tesla, Apple, Amazon, that all had pretty significant declines in their respective companies, which helped to drag other indexes down lower. And so here we have the NASDAQ index, and I just want to show you a couple of things here. Number one, so here's our 50-day moving average, and so you can see, so this is as we began this most recent corrective process that we're in right now. We were very deviated here. We've come back down. We literally kissed the 50-day moving average, and it has acted like a decent line of support. We actually violated it last week, but then we were able to come back above and kind of sit right on it. Now again, we're seeing weakness in the market again today. We saw a huge rally on Monday. Indexes were up over 3%. And then we saw some weakness again yesterday and then today. So yesterday we were able to hold the 50-day. My suspicion is that today we will probably wind up closing right below that on the NASDAQ. And something else that I wanted to show you, we're really sensitive to the fact of when we look at some of these numbers of particularly relative strength, when we get above these ranges of 70, it's like you can almost say like we're going to have a correction. And so you can see this very clearly here and here. You can see here we kissed it here, and then here we hit it right here and had that decline. I'm going to show you in another area where it's even more defined. So, and actually I can show that right now. So this is one of our tech funds. So tech, like I said, has been particularly impacted in these last few trading days. And so we have seen, I won't say a rotation out because I don't know that it's fair to say that we're actually rotating away, but we've absolutely seen significant outflows coming from the tech sector. And so this is one of our tech funds that we have, which is, it is just a tech fund. So this fund, which has had a really great advance for the past 6 months, as you can see, when we hit this deviation here of RSI, we were up at about 75% here. And so you can see as soon as we hit that trigger, you can only trade so far ahead and so kind of out of the realms of normality before there has to be something that kind of brings us back down. Now here you can see where the 50-day absolutely acted perfectly as a line of support. We came down, we sat on it, we bumped above it again. Now today, this fund is also down again. I would expect that we would likely we're going to be probably sitting right on that 50-day today, so we'll have to see what the movement is tomorrow. But you can see, so these long-term moving averages, they do act as a magnet, drawing us back down. We can only get so extended. So I tell clients, I tell people who I talk to, it is always disconcerting when we see significant moves in the market. And nobody cares when we see significant moves to the upside like we've seen. I mean, this fund has taken a complete, just straight shot up with hardly any breathers at all. And that's not normal, that's not healthy. The only way that a market can really continue to achieve new highs is that when we get this far and away is to kind of come back down, take a breather, and then we can advance again. And so as you can see where we've moved for the last 6 months, it's been pretty significant. But when we get too far deviated, that's the problem that we wind up seeing. And so just the last thing that I wanted to show you, so we want to look at our different asset classes and just how we are kind of doing when we look at dynamic asset level investing, because this is kind of every day we look at our snapshot. What are the best areas of the market? What are the worst areas? They don't change day by day, they change over time. And so as you can see, domestic equities is still the best place to be. I'm going to come on this side so you can see that. And then we have small cap, mid cap growth. Large cap growth has kind of been trailing, not significantly though. We still have large cap exposure, mainly because we don't want to just have small and mid. They've really been on a tirade. They've also really been affected by this interest rate change that we've seen, because again, a small and mid cap company is going to be even more heavily impacted by the ability to borrow assets at a lower amount. So something interesting though that we've seen within the sectors, technology for about a year has been in the #1 slot. And we have seen energy and consumer cyclicals kind of begin to, has kind of began to leapfrog over technology. But as you can see, technology in the 3rd slot and very handedly over the next slot, beating us with buy signals that we look at, tells us that technology is still a very strong place to be. Energy in the #1 slot is interesting. We're watching it. Energy also tends to be a very volatile space, and so we have seen energy slide up, make rapid movements like it's made, and then the same very rapidly move back down. So we're watching energy. Consumer cyclicals we've had exposure to since the summer, so that's all good. So it's really the energy space right now that we're watching, keeping an eye on, saying, hey, do we want to add some exposure here? So we're watching to see what the individual relative strengths of some funds underneath do. But again, technology still remains to be a strong area. And if I show you in technology, so that fund, that tech fund that I just showed you a couple of minutes ago, I want to show you. So even though we've seen some fairly quick movements in that fund, when we look at its relative strength is actually still, it's a 5.9. Remember, the best score that a fund can get is a 6. So we're at 5.9. Average scores in the tech industry are at about 4.9. Still a very strong area to be. We are still on a buy signal with a positive trend in a column of X's. So really, this tells us that from a technical standpoint, for now, what we're seeing, it's a healthy pullback. This is something that kind of needed to happen. If you can almost imagine, after you've ran a really long race, you have to stop and kind of gather yourself, take a deep breath, pause, and then you're ready to move on. So it's very likely that that's what some of these areas of the market are doing. Now, it just so happened that what caused the pause was probably these interest rate hikes that we saw. Now, something interesting is last week, the Federal Reserve did come out and speak. Jerome Powell kind of trying to reassure the markets that from the Federal Reserve side, they plan on keeping interest rates low for the foreseeable future. They're not planning on purposely hiking interest rates, and so that helped to calm some of the uneasiness that we were seeing. So we're just going to have to see with these inflationary moves that are happening, if they continue. After 10-year Treasury yields spiked to the 1.6, we did see them begin to kind of trend back down, settling about 1.4, which again helped to kind of calm the markets, that we weren't just going to be on a straightaway with bond yields. So we will just have to watch that. But for now, what we're seeing is market movements. They go up, they go down. And so that's kind of the way that markets work. And again, everybody is always really comfortable and fine when we see these unreasonable moves to the upside, but just realize that they kind of move in tandem. So when we see them move up and deviate and be overvalued, at some point we have to expect that they at least need to kind of take a breather. And so that's likely what we're seeing. Again, we're keeping a very close eye on it, because as we learned last year in 2020, things can change very quickly. And so we're monitoring it. We spend a huge portion of our time on investment management, but I thought it would be interesting so that we could at least kind of discuss that today, show you some of the things we're looking at, that we're seeing. Next week, we'll be covering any other moves that also happen within the market. If there's things that you have questions about, you're not sure with your portfolio, why you're allocated the way you are, we're always happy to take a look at that and kind of go over things with you. You can give us a call. I'd love to hear some areas that you would like us to continue to kind of extend our what we talk about. I am planning on doing some additional podcasts and actually even bringing in some other experts to come in and talk about specific areas in the coming months. So really looking forward to that. Thank you so much for joining us, and we will see you next week. Take care.